Mastering the Market Cycle. Getting the Odds on Your Side by Howard Marks. Hello, and welcome. I want you to imagine something for a moment. Picture one of the most brilliant minds in human history. A man who formulated the laws of motion and universal gravitation. Someone who essentially wrote the rulebook for how the physical universe works. I'm talking about Sir Isaac Newton. In the year 1720, England was gripped by a frenzy. A company called the South Sea Company promised unimaginable riches from trade with South America. Everyone was buying its stock. Friends, neighbors, blacksmiths, nobles. Everyone was getting rich. The stock price soared, day after day. Newton, a cautious and brilliant man, invested early. He made a handsome profit and sold his shares, doubling his money. As he cashed out, he reportedly said, "I can calculate the motions of the heavenly bodies, but not the madness of the people." A wise move from a wise man. But then, the stock kept rising. And rising. And rising. All around him, Newton saw his friends, people far less intelligent than him, making fortunes. The pressure, the envy, the fear of missing out, it became too much. The great Sir Isaac Newton, the man who understood the universe, couldn't bear to be left behind. He jumped back in. He bought the stock again, near its absolute peak. And then, the bubble popped. The crash was swift and brutal. The stock collapsed, and in the end, Sir Isaac Newton lost a fortune, the equivalent of millions of dollars today. The man who discovered gravity became a victim of it, financially speaking. What happened there? Why does a genius fall for the same trap that catches so many others? And more importantly, how can we avoid the same fate? That's the question that sits at the very heart of a remarkable book by one of the most respected investors of our time, Howard Marks. It's called Mastering the Market Cycle. Getting the Odds on Your Side. Now, I'm going to make you a promise. By the end of our time together today, you won't have a crystal ball. You won't be able to predict whether the market will go up or down tomorrow, next week, or even next year. Instead, you'll have something far more powerful. You'll have a map. You'll have a way of understanding where we are right now. You'll learn to recognize the signs of greed and fear, of optimism and pessimism, that drive the markets. You'll understand that while we can never know where we're going, we can have a very, very good idea of where we stand. And that knowledge, as Howard Marks teaches us, is the key to tilting the odds of success dramatically in your favor. Howard Marks isn't just an author, he's a legend in the investing world. He's the co-founder of Oaktree Capital Management, a firm that manages over $100 billion. And his memos, which he sends to his clients, are considered essential reading by the best in the business. In fact, Warren Buffett himself has said, "When I see memos from Howard Marks in my mail, they're the first thing I open and read. I always learn something." Today, we're going to open those memos together. We're going to learn what Buffett learns. We're going to dive into the core wisdom of mastering the market cycle, and by the end, you'll see the world of money, business, and investing not as a chaotic casino, but as a series of understandable patterns. Patterns you can learn to navigate for the rest of your life. So, let's begin with a simple drawing. It's a drawing Howard Marks has made hundreds of times for his clients on a piece of paper or a whiteboard. I want you to picture it in your mind. Imagine a straight line, sloping gently upward from the lower left to the upper right. This line represents progress. Over the long run, economies tend to grow, companies tend to become more profitable, and markets tend to rise. This is the secular trend. It's the slow, steady march of human ingenuity and aspiration. If the world were run by robots, this might be all we'd see. But the world isn't run by robots. It's run by people. And that's where the second line comes in. Picture another line, a wavy one, that oscillates up and down, crossing that straight trend line again and again. It swings far above it, then plunges far below it, but it always, eventually, comes back toward that central line. That wavy line, that's the cycle. That's everything. It's the economy swinging from boom to recession. It's the stock market swinging from euphoria to despair. It's the real estate market swinging from a frenzy of construction to a landscape of empty buildings. Most people see these swings as a series of random events. A good year is followed by a bad year. A boom is followed by a bust. But Marx reveals the first profound secret to understanding them. The events in a cycle are not just a sequence. One doesn't simply follow the next. One causes the next. This is the most important lesson you will ever learn about how markets work. Prosperity causes the behavior that leads to a bust. And a bust causes the behavior that leads to the next prosperity. Let's unpack that. Think about it like a pendulum. As Marx explains, the market is constantly swinging between two extremes. On one side, you have greed, euphoria, optimism, and a complete tolerance for risk. On the other side, you have fear, depression, pessimism, and a total aversion to risk. The pendulum rarely, if ever, rests in the middle, at what you might call a happy, rational medium. It's almost always swinging toward one of the extremes. So, let's follow the swing. Imagine the economy is doing well. Companies are reporting great profits. The news is positive. People feel secure in their jobs. What happens to the pendulum? It starts to swing toward greed. Investors, feeling optimistic, start to believe that things can only get better. They forget about risk. After all, what is there to worry about? Everything is going great. This is what Marx calls the first stage of a bull market, a time when only a few perceptive people see improvement. But as the good news continues, we enter the second stage. Now, most people realize things are getting better. They start buying stocks, real estate, whatever is going up. Their buying pushes prices higher, which validates their decision and makes them feel smart. This creates a feedback loop. Good news leads to optimism, which leads to buying, which leads to higher prices, which creates more good news, which creates more optimism. And this is where the danger starts. The pendulum is now swinging far from the middle. People stop asking, "What's the risk?" and start worrying only about the risk of missing out. This brings us to the third and final stage of a bull market. The stage where, as Marx puts it, everyone concludes things will get better forever. At this point, the belief that this time it's different takes hold. People find clever reasons why old rules of valuation no longer apply. You'll hear things like, "They're not making any more land," or for a hot new tech company, "There's no price too high for a great company." This is the hallmark of a bubble. It's the moment when emotion has completely taken over from logic. Think back to the dot-com bubble in the late 1990s. Companies with no profits, sometimes no revenue, were being valued at billions of dollars. Why? Because the story was that the internet would change the world. And it did. The story was true. But the prices paid for stocks based on that story were disconnected from any rational calculation of value. People weren't buying businesses, they were buying lottery tickets, driven by the fear of missing out as they watched their neighbors get rich. This is the point of maximum risk. Why? Because all the optimism, all the good news, is already reflected in the prices. The prices are flawless, priced for a perfect future. There is no margin for error. As Warren Buffett says, the less prudence with which others conduct their affairs, the greater the prudence with which we should conduct our own affairs. When everyone is euphoric, a wise investor should feel terrified. And this is where the beautiful, brutal logic of the cycle kicks in. The very success of the boom carries within it the seeds of the next bust. How? Marx points to something he calls the race to the bottom. This happens in what he considers the most important and volatile cycle of all, the credit cycle. Think of the credit cycle like a window. When times are good and everyone is optimistic, the credit window is wide open. Banks and lenders are eager to give out money. Why? Because they're competing for business. To win a deal, they have to offer better terms than the next guy. This means lower interest rates, weaker protections, what they call covenants, and a willingness to lend to riskier borrowers for riskier projects. As Marx says, the worst loans are made at the best of times. During a boom, lenders finance projects that would never get a green light in normal times. They give mortgages to people who can't really afford them. They fund corporate takeovers with mountains of debt. They are essentially stacking logs in the fireplace, creating the fuel for the next bonfire. This is exactly what happened in the years leading up to the 2008 global financial crisis. The credit window was not just open, the wall had been knocked down. A belief took hold that home prices could only go up. This, combined with an insatiable demand from Wall Street for mortgages to package into complex securities, led to the unwise extension of credit on a scale never seen before. Lenders created subprime mortgages for borrowers with poor credit, sometimes without even verifying their income. Why would they do this? Because they weren't planning on holding the loans. They could make the loan, collect a fee, and immediately sell it to an investment bank, which would slice it and dice it into a mortgage-backed security and sell it to investors all over the world. The risk was passed on. Everyone in the chain was making money, and no one felt responsible for the underlying quality of the loans. The pendulum of risk aversion had swung to zero. So, we have a market at its peak. Prices are sky high. Psychology is euphoric. And the financial system is saturated with risky debt made on the assumption that the good times will last forever. The pendulum has swung as far as it can go to the side of greed. It has stored up a tremendous amount of energy. And now, it's ready to swing back. All it takes is a spark. The spark could be anything. A recession, an unexpected political event, or simply the fact that the high prices can no longer be sustained. In the case of 2008, the spark was that those subprime mortgage borrowers started to default. The assumption that home prices only go up was proven false. And suddenly, the entire logic of the boom reverses. This is where Marx's description of the 3 stages of a bear market begins. The first stage is when just a few thoughtful people realize that, despite the optimism, things can't stay rosy forever. They start to sell, or at least stop buying. Then comes the second stage. The bad news becomes more obvious. Most investors now recognize that things are deteriorating. The selling picks up. Prices start to fall. The feedback loop that worked so well on the way up now works in reverse. Falling prices create fear. Fear leads to more selling, which pushes prices even lower. The media, which was celebrating new market highs just a few months before, now runs headlines of doom and gloom. And this leads to the third stage of a bear market, when everyone is convinced things can only get worse. This is the point of maximum pessimism. It's the polar opposite of the bubble's peak. Now, fear has completely taken over. No one is worried about missing an opportunity. They are only worried about losing more money. The conviction is, get me out, at any price. This is the moment of capitulation. It's when even the investors who held on through the decline finally give up and sell. As Marx so wisely observes, what the wise man does in the beginning, the fool does in the end. The wise man was buying in the depths of despair when no one else would. The fool is the one who finally sells at the bottom, locking in their losses, because they can no longer stand the pain. Let's go back to the credit cycle. What happens to that credit window now? It slams shut. The same lenders who were fighting to give away money are now terrified. They won't lend to anyone. Good companies? Bad companies? It doesn't matter. Credit becomes scarce. This creates a vicious circle. Companies can't refinance their old debt, so they go bankrupt. Bankruptcies lead to job losses. Job losses lead to less consumer spending, which hurts more companies. This is exactly what happened in the fall of 2008. After the investment bank Lehman Brothers went bankrupt, the financial system froze. Panic was everywhere. It was a time of pure terror. Marx describes a meeting he had with a pension fund during this period. He was explaining an opportunity to invest in distressed debt at prices that implied incredibly high returns. But the fund manager kept asking, "But what if it's worse than that?" He kept pushing for a doomsday scenario. For Marx, this was a revelation. It was the signal he had been waiting for. When everyone is so consumed by fear that they can't imagine any positive outcome, no matter how cheap assets get, that is the moment of maximum opportunity. At the bottom of a cycle, all the bad news is already priced in. The pessimism is so thick, there is no room for negative surprises. The risk of loss, ironically, is at its lowest point precisely when everyone perceives it to be at its highest. This brings us to the core of Howard Marx's philosophy on how to cope with these cycles. It's not about prediction. It's about positioning. You will never, ever know for sure when the top or the bottom will happen. Trying to pinpoint the exact day is a fool's game. As Marx says, the bottom is only recognizable after the fact. It's the day before the recovery begins. Waiting for certainty means you will miss the opportunity. So, what do? You learn to take the temperature of the market. Marx provides a brilliant checklist for this. You don't need a complex financial model. You just need to be a keen observer of your environment. Ask yourself, are investors optimistic or pessimistic? Is the news media full of good news or bad news? Are lenders eager to lend, or are they tight with their money? Are new investment schemes being embraced with excitement, or are they met with skepticism? When you see a new deal, is the talk all about the potential for high returns, or is there a healthy discussion about the risks? Are people saying buy the dips, or are they afraid to catch a falling knife? When the checklist is full of check marks in the optimistic column, when capital is plentiful, risk is seen as a friend, and everyone is eager to buy, that's when you should be most cautious. Your portfolio should be positioned defensively. This doesn't necessarily mean selling everything. It might mean holding more cash, owning higher quality assets, and avoiding leverage. It's about reducing your risk of losing money. Conversely, when the checklist is full of check marks in the pessimistic column, when fear is rampant, capital is scarce, and everyone is selling, that's when you should be aggressive. That's the time to worry about the risk of missing opportunity. Your portfolio should be positioned to take advantage of the bargains that fear creates. It sounds simple, but it is one of the hardest things to do in practice. Why? Because it requires you to be a contrarian. It requires you to be cautious when everyone around you is getting rich and celebrating. It requires you to be brave and buy when everyone around you is panicked and certain the world is ending. It requires, as Sir John Templeton said, the greatest fortitude, but it also pays the greatest reward. This brings us to one of the most interesting cycles Marx discusses, the cycle of success itself. Just as success in the market leads to the excesses that cause a bust, personal success can have the same effect on an investor. When an investor does well, especially in a rising market, it's easy to start thinking you're a genius. As Marx jokes, you must never confuse brains with a bull market. Success can make an investor overconfident. It can reduce their humility and make them forget the role luck played in their achievements. They might start taking bigger risks, thinking they can't lose. They might branch out into areas they don't understand. Their success attracts more money, and managing a much larger pool of capital makes it harder to repeat the nimble strategies that worked when they were smaller. In short, success changes behavior, and that change in behavior makes future success less likely. And the opposite is also true. Failure is a powerful teacher. It fosters humility. It forces a return to fundamentals. It reminds us of the importance of risk management. The investor or the company that survives a near-death experience often emerges stronger, leaner, and more disciplined. Just as booms sow the seeds of their own destruction, failures can sow the seeds of future success. The cycle applies to us too. So, as we bring our journey to a close, you might be asking a final, crucial question: will cycles ever go away? Over his long career, Marx has heard the proclamation that the business cycle has been tamed many times. Before the crash of 1929, in the late 1990s, during the tech boom, and in the mid-2000s, during the great moderation that preceded the global financial crisis. Each time, the reasons were different. A brilliant Federal Reserve chairman. New financial innovations that supposedly eliminated risk. A new global economic paradigm. And each time, the prediction was profoundly wrong. In fact, Marx points out that these proclamations are themselves a reliable sign that we are near a cyclical peak. The belief that cycles have ended is a product of the same euphoria that drives bubbles. Cycles will never be eliminated. Why? Because they are not driven by mechanics or scientific laws. They are driven by people. And people, as Richard Feynman, the great physicist, once joked, have feelings. If electrons had feelings, physics would be a lot harder. Investing is harder. Because we humans will always swing between greed and fear. We will always extrapolate recent events into the future. We will always have a tendency to become too optimistic when things are good and too pessimistic when things are bad. The tendency for human beings to go to excess will never end. And because excesses must eventually correct, the occurrence of cycles will never end. This is not a cause for despair. It's a cause for hope. It means that for the investor who understands this dynamic, who studies history, who has the emotional discipline to stand apart from the crowd, there will always be opportunities. There will be times when the market offers up incredible bargains, if only you have the courage to buy them. And there will be times when the market becomes a dangerous place, if only you have the prudence to be cautious. Mastering the market cycle isn't about having a special power. It's about developing a special kind of awareness. An awareness of history, an awareness of psychology, and most importantly, an awareness of where we stand today, in the great, endless, and beautiful oscillation of the market. Commentary. So, what do we take away from all this? As I reflect on Howard Marx's wisdom, one central idea shines brighter than all the others. It's the simple truth that the greatest risks and the greatest opportunities in investing don't come from the economy, or from spreadsheets, or from some complex analysis of a company. They come from us. From people. The market isn't a thing. It's a reflection of the collective mood of millions of human beings. And because of that, it will always be prone to wild swings of emotion. Learning about cycles is really about learning about human nature. It's about understanding that our collective psychology swings like a pendulum, from euphoria to despair, and that these swings are what create the cycles we see in asset prices. What I find so powerful about Marx's approach is how it liberates you from the impossible task of predicting the future. He's telling us to stop guessing and start observing. To stop trying to be a psychic and start being a detective. The clues are all around us, in the headlines, in the behavior of other investors, in the kinds of deals getting done. Are people acting prudently, or are they throwing caution to the wind? That's the most important question you can ask. So, how can you start applying this wisdom to your own life, right now? Here are 3 simple actions you can take. First, become a student of history. The next time you have a free afternoon, don't just watch a movie. Go online and read about a past market bubble. The South Sea bubble of 1720, the dot-com bubble of 1999, the housing bubble of 2007. As you read, don't focus on the financial details. Focus on the human story. Notice the language people used, the feeling of inevitability, the belief that this time it's different. You'll start to see that, as Marx says, history doesn't repeat, but it certainly does rhyme. Second, start taking the market's temperature yourself. Create a simple mental checklist. When you read the news or hear people talking about money, ask yourself, is what I'm hearing driven by greed or by fear? Is the overall mood one of optimism or pessimism? You don't have to invest a single dollar. The goal is just to practice observing the psychological climate. Over time, you'll develop a feel for it, an intuition that you can't get from a textbook. And third, practice thinking like a contrarian in small ways. The next time you see a stock that everyone is excited about and that has already gone up a lot, just pause and ask yourself, how much good news is already baked into this price? And conversely, the next time you see a good, solid company whose stock has been crushed because of some temporary bad news, ask yourself, how much pessimism is baked into this price? Again, you don't have to act. You are simply training your mind to look for value where others only see popularity or despair. Ultimately, the journey to mastering the market cycle is a journey of mastering yourself. It's about developing the emotional fortitude to be disciplined when others are reckless, and to be brave when others are terrified. It's not about being smarter than everyone else. It's about being more disciplined. That was a deep dive into Mastering the Market Cycle by Howard Marks. We've explored the core ideas today, but I'll be honest with you, a summary can only take you so far. The real magic happens when you hold the book in your hands and let the ideas settle. It's in the quiet moments, when a particular story or a simple phrase hits you in a way you didn't expect. This summary is designed to help you decide if this book is worth your time and attention. If anything we've talked about today has sparked your curiosity or resonated with your own experiences, I wholeheartedly encourage you to grab a copy. Reading it isn't just about learning. It's an experience that can genuinely change the way you see the world of investing and, perhaps more importantly, the way you see yourself. You can find a link to the book in the description below. Also, if you found this summary valuable and it gave you a new perspective, please take a moment to click that like button and subscribe to the channel. It lets us know we're on the right track and ensures you won't miss our next journey into another life-changing book from the billionaire's bookshelf. Let's keep learning and growing together. Thank you for listening.